Mark, we were just talking to Richard Windsor about tech and about the tech sell-off we've seen and what drove that. I know on the Markets Live blog, you guys have been talking about how there wasn't much of a catalyst. Some people have attributed this MIT report and a write-up of it that suggests that AI projects and pilots are not very successful. What are you looking at in terms of this sell-off in tech and how sustained it will be?
I think it makes complete sense. We talked about this in the show on Monday, that we suddenly came into this week and AI was suddenly looking very vulnerable, specifically AI, after not being the weak link for the last few years. And I think, obviously valuations are stretched, but that's never a timing tool. But we've come into a period of where it's seasonally not great for the retail sector. There's been a big buyer of these mega cap tech names. But the really big catalyst on the horizon is, of course, Jackson Hole. And the bias for the next month, out of maybe not immediate reaction at Jackson Hole, but a delayed reaction at Jackson Hole or immediately, will be higher long end yields. And that's when AI is much higher duration asset than it was previously because of its capex cycle. So we've got a hype cycle that's extended relative to the impact cycle. We've got retail participation down just seasonally. We've got Jackson Hole on the horizon. We've got Nvidia earnings that are priced wonderfully, and they will be wonderful. They'll be absolutely wonderful. We know that all the AI earnings have been really strong this month, so that's already fully priced. They'll do great next week, and still the AI sector will sell off. I do expect this to be extended. I expect the next month to be very tough for AI. It's something we talked about already on the show this week, and I think that's going to be weigh on risk sentiment everywhere because we've got such a concentration of risk there. And it's not just about Jackson Hole. Remember, we've got potentially chip tariffs on the horizon, and we've also got the US administration taking revenues directly from some of the big names in this sector. Nvidia and AMD have already been targeted, but the White House announced last week they're looking to expand that revenue sharing idea, which means this is a chunk of profits being taken directly from companies.
Mark, is Powell going to flatten the curve?
I don't think so. Particularly, I'll say that there's two ways we go this way. Let's simplify it, right? So either he validates the dovish pricing, and then the reaction will be, oh my God, he's folding to administration pressure, and you'll see a twist steepening. You'll see the front end come down and the long end rise. Now the alternative is that he emphasizes that, hey, we've got a supply side problem in the labor market because the immigration crackdown, and therefore you respond with rate cuts to a supply side problem. That's not going to solve the labor issue, and hey, we've got a big inflation problem. And that would ultimately see a short-term flattening, but it'd be a bearish flattening. We'll see front-end yields jump. It won't see long-end yields kind of come down too much. And that's because the backdrop picture is everyone knows as soon as he pushes back on rate pricing, the administration will double down on pressure because of Powell's intransigence. And that means that all we do is see a delayed twist steepening from a higher level. So if he is hawkish, you actually see higher yields just move higher later, but in a much more powerful fashion. Either way, yields are going higher over the next month.